Friday, May 18th, 2018. Bottom line, mortgages are within an inch of 5 for the first time in 7 years. The Freddie Mac release, which went out yesterday, they have surveyed mortgage markets back to 1971, and they have a survey lag. They collect their data primarily on Mondays and Tuesdays and release it as news on Thursdays. And so in a week like this one, when markets went a little haywire late on Tuesday and into Wednesday, didn't get captured. So the 4.61 that Freddie says, no, we're just short of 5, and we're going to go through 5. The why involves the Fed. The Fed went to 0% at the end of 2008, and 3 years ago began its first ever so slight beginnings of what it has called normalization, meaning coming up from an emergency level to something closer to normal. Now, normal at the Fed involves trying to calculate what should the overnight cost of interest be, neither leaning against the economy nor easy. What's neutral? And they have a term for it, which is the lowercase r followed by an asterisk, known as R star. And as the Fed economists say, it can't be observed directly, which means we don't know where it is. We guess all the time. And the assumption is that in a world still deflation pressures, globalization, it's a big deal. The suppression of U.S. wages, big. Japan is still a mess. Europe hasn't changed in 10 years. China is trying to get off of debt, and which means slow down. Guesses are that the Fed still says that it thinks that it's some distance below the neutral rate of interest. Market movements this week have convinced this old-timer that the Fed has begun to actually lean into the economy. And the rise in mortgage rates from 4.5 to 5 is one of the tip-offs. The article next to this video is nearly incomprehensible, but for people who can handle a little mathematics, the relationship between 2-year T-note, 10-year T-note, and 30-year bond, as the spreads between these instruments change, tell us what the market thinks. Markets are not correct, certainly not absolutely correct, but they, in the Treasury market, for just these instruments, the market places a vote by a great many people and a great deal of money about how the world looks. And we've gone from a period of super easy Fed pushing up like this on short-term interest rates, and at some point pushing up on short-term interest rates has an effect out here. And that began about a month ago, and it intensified this week. Further Fed rate hikes are going to have nearly one-to-one effect on mortgage rates. And the spread between 2s and 10s defines our life. That spread is now just about a 0.5 percentage point. It started to narrow and then popped back out to a 0.5 percentage point. Fed's going to tighten again either June or July, and we'll see if that immediately follows through the mortgage rates, and my hunch is that most of it will. What nobody knows is at what point does the Fed accidentally cause a recession? Does the Fed get mightily lucky? There's a chart next to this video that shows the only time ever that the Fed got lucky and created a soft landing, where it raised rates continuously for a time and then rates stayed the same and the economy did well for a period of 4 years afterwards. It's the only time that ever happened was in the early 1990s. The odds are against that happening again. Likelihood is that the Fed, with the best of intentions, continues to push up on rates, and then, holy smokes, one day, where did this recession come from? Effects on housing, risk and so on are a different story. Not likely to be bad, but the Fed's leaning into us now. Sometimes it happens. I don't mean to be unpleasant on Fridays. It's just sometimes that's the way it is. Have a nice weekend.